What's up, guys? I'm Mike from StockedUp. In this video, I'm going to be talking about selling call spreads because on the Option Titan watch list I post every single night, you could see that it clearly says, for example, Shopify was on the Option Titan for last night, and I was saying Shopify puts, but I said it's safer to sell call spreads. So I've made probably 5 videos on this topic already, but I'll explain, for the Option Titan more specifically. So when you think a stock's going to go down, you can buy a put. When you think the stock's going to go up, you could buy a call, right? You'd make money. If you think the stock is going to go down, you can buy a put, but you can also sell a call, right? Because if you sell a call, whatever you sell it for, the call is going to lose value, because if it goes down, the call gets further out of the money, right? So you would profit there. It's like shorting. If you think the stock's going to go up, you could buy a call or you could short a put, all right? Because if the stock does go up, the put that you sold for, like let's say you sold the put for like $50, the put would get further out of the money and it would be worth like $20, right? So you could profit off that way too. Now, probably 90% of beginner accounts cannot just sell what's called naked calls or naked puts. This is because there's unlimited risk, all right? And you could really lose a lot. So what we're doing and what I recommend is called call spreads or vertical call spreads or vertical put spreads. So these spreads allow us to limit our profit and then limit our reward. Now you guys know that I'm doing a lot of put spreads on the S&P 500, right? Those types of put spreads are different from the ones I'm going to show you in this video. On the S&P 500, I'm playing debit spreads. So like I'm playing vertical debit, put spreads. So I want the market to fall. But in this video, we're going to be talking about call credit spreads and also put credit spreads. So we're going to go to Shopify, and I'm going to show you what I mean. So let's take a look at Shopify chart. So we could see it fell, like I called Shopify out on 6/25, so yesterday. We could see Shopify fell a pretty decent percentage. I mean, it fell about 40 points in 2 days, right? So that's a lot, especially for Shopify. So what we can do is instead of buying puts, right, and thinking that the stock's going to fall even more, right, that might not happen. Like Shopify might just consolidate like it is now, just like a doji, or it might go up a little bit or it might go down a little bit. But if we go to the chain right now, the options are still extremely expensive. So it it would cost you a lot of money to buy a put, and then even if you did, like let's say you bought like a put for $100, that's still almost 20 points out of the money. You know what I mean? So and then let's say you even bought something for $300 at 282.5. One, it's still 5 points out of the money, and then even if it does fall, you would need like a significant fall to make a decent return. So it's not the best play, what you could say. So it's more safer if you capitalize off these expensive options. So let's say we think Shopify is going to go down or stay the same, right? And that's it's safer to sell call spreads. It is very important. So I'm on Thinkorswim. When selling credit spreads, 90% of the time, you do not want to sell in the money, right? There are some strategies where you could sell the credit spreads in the money. I have a couple of them, but for this video, just focus on out of the money credit spreads. So what we're going to do is we're going to take a look at Shopify chart, and we're going to be like, all right, it's Shopify. We're going to make the bet that Shopify is going to close less than or $300 by Friday, right? So we pick the Friday expiration. We pick the 300 strike price, right? So what we would do is we would sell this 300 strike call option. All right, I'm holding down control, and then I click the bid, and then I'm going to go to the 302.5 call option, still holding down control, and we get to that. I'm going to get a credit of, let's see, we'll go $50. So if Shopify expires if Shopify expires below 300, then I'm going to keep this entire credit. If it doesn't, then I'm going to lose $200. So how do I know I'm going to make 50 and how do I know I'm going to lose 200? So one, I know whatever your limit price is, if it expires out of the money, you're going to keep that entire limit price for yourself. If Shopify goes up, all right, to measure your losses, it's called the width of strikes. So we could go to the $300 and $302.50. What you do is you take the difference between them. So we know it's $2.50, right? We know that all options are multiplied by 100. You know, this option right here isn't 80 cents, it's $80. This option right here isn't $2.35, it's $235. Everything with options is multiplied by 100, right? So the width of the strikes is $302.50 minus 300. That's $2.50, right? Multiplied by 100, that's $250, right? That's the width of the strikes. So take your credit, which is 50, and subtract it from that. So that gives you your max loss. Okay? So your max profit, 50, max loss, 200. So that gives you a 25% return on your money, which isn't bad, and time works for you. You know what I mean? So like Shopify can go up all the way to $299 and you'll still make money, right? So that's great. What else? And then, you know, the same thing works on the downside. You just sell the put, you're always selling the option closer to the money. So with calls, you're always going to sell the option that's closer to the actual price and then buy the one on top. So for example, like with puts, you would sell the 270 and you would buy the 267.5. With calls, you would sell the 300 and buy the 302.5, right? Like sell and then buy. So sell and buy. You know, you don't have to sell the 300 strike. The closer you are to the money, the bigger returns you're going to get. But that also comes with, you know, a higher chance of losing. What else? And you know, yeah, like the same thing works on the downside. I've made a couple videos on this, so check out the channel. So yeah, like, you know, I like to sell credit spreads when the options are expensive. It's easy to capitalize off that, just like Shopify. And yes, so you know, you could get really creative with these in the future, but you definitely want to start off like simple. Like you could sell what's called an iron condor, which is when you sell a call and a put spread. So that's pretty cool to do too. But if you have any questions, just let me know in the comments down below. But other than that, thanks for watching.